Let's jump right into today's explainer on XPON 360. We're looking at a wild, extremely volatile stock right now, a situation where massive upside potential is literally colliding head-on with existential financial risk. So what is XPON 360? Traded under the ticker XPON, this is a micro-cap company designing premium lithium iron phosphate batteries. Think lower weight, higher usable power, longer cycle life, and smart connectivity built right in, mostly for RVs, marine, and industrial use. But here's the absolute crucial context, their size. We're talking about a tiny market cap of around just $7 million. Attempting to disrupt a premium hardware market at this scale, man, that is essentially an uphill battle where every single dollar counts. At this micro size, traditional valuation metrics, PE ratios and things like that, they're virtually meaningless because the company's still deeply unprofitable. You really have to view this whole situation through the lens of a high-risk turnaround, or a growth option rather than evaluating them as some conventional established battery manufacturer. Now, if we want to build the bullish argument, the very first thing that jumps out is their fiscal year 2025. They saw a massive 72% spike in top-line revenue, leaping from $5.6 million to $9.7 million. Psychologically for investors, a jump like this is a huge deal. It proves the company can actually generate serious demand and move product when OEM shipments cooperate. It proves product market fit, right? But the underlying reality reveals itself when you look at the net income. Despite that massive top-line jump, well, net income remained a loss. So revenue spiked, but no, they didn't magically become a profitable machine overnight. And this severe disconnect between top-line and bottom-line growth is where the mechanics of this business get really fascinating. Get this. Revenue grew by a staggering 72%, yet gross profit only grew by a measly 16%. So why does that happen? Well, historically, the company just struggled to translate sales into actual profitability. We're talking poor product mix, high manufacturing costs, relying way too much on low-margin accessories, and just a fundamental lack of scale economics. Think about economic leverage for a second. When you're a microcap generating around $10 million in revenue, but your margins are terrible, you simply have almost zero economic leverage to cover your fixed operating expenses. Every dollar of revenue gets eaten up before it ever has a chance to fall to the bottom line. And unfortunately, that 2025 momentum, it didn't last. The first half of 2026 brought a pretty harsh reality check, with revenue dropping 29% year over year. Now, management attributed part of this steep decline to intentionally discontinuing some of those low-margin accessories we just talked about, but a much larger factor was elevated battery inventories held by some of their OEM customers. And this perfectly illustrates the danger of customer concentration. Demand can be so volatile. When you are a small supplier, elevated inventory at just one or two major partners can send a massive shockwave right down the supply chain, hitting your top line directly. That kind of inconsistency in demand is just a structural risk factor you have to accept with any microcap hardware business. Yet, despite that really concerning revenue drop, the second quarter of 2026 delivered what is arguably the most encouraging development of all. Gross margins jumped to a highly impressive 32.4%. I mean, they stepped up from just 20.8% in the same quarter the previous year. In fact, their actual gross profit increased by 6%, even though their overall revenue was down significantly. When you're analyzing a company of XPON's size, improving unit economics is literally everything. Proving that your product can actually be sold profitably, that's the holy grail for a struggling startup. Honestly, it's arguably way more important than just chasing top-line revenue growth in the short term. Because let's face it, growth without margin is just a faster path to bankruptcy. Now, this crucial margin expansion wasn't just some happy accident. Management deliberately executed a very specific four-step playbook to build that vital economic leverage. First, they eliminated those low-margin accessories. That takes guts, because it means sacrificing top-line vanity metrics for long-term health. Second, they doubled down and focused entirely on their core premium battery products. That's where their true competitive advantage is. Third, they maintained strict pricing discipline. They resisted that desperate urge to slash prices just to move volume during a tough quarter. And fourth, they aggressively pursued manufacturing efficiencies, basically squeezing every possible drop of margin out of the production process. If they can maintain this disciplined structure as revenue inevitably scales back up, the underlying business transforms completely. On top of that, their expanding relationship with major RV manufacturer Forest River provides some really crucial brand credibility, and of course the potential for recurring volume. In May 2026, they added the Georgetown and Dynamax Grand Sport motorized RV brands to their portfolio. This is strategically huge. Expanding these OEM relationships provides larger production volumes and sets a baseline for factory utilization. But more importantly, it significantly lowers customer acquisition costs. Instead of having to fight tooth and nail for every single retail consumer, securing these major brand partnerships draws a very clear line between consistent orders and the company's ultimate survival. But they aren't stopping there. They're looking well beyond the cyclical RV market. They're developing next-generation smart batteries, plus the DAS Gen system, which targets a massive total addressable market in construction. Their new EX1 battery actually includes internal heating and CAN bus communication, which is awesome for cold weather performance and smart functionality. But the real game changer here could be that DAS Gen hybrid energy storage system. This thing acts as an energy buffer between diesel generators and job site electrical loads, potentially reducing generator runtime. This represents a massive pivot. They're shifting away from just consumer leisure and moving directly toward temporary power, commercial energy systems, and industrial utility, markets that are far more lucrative and, frankly, way more stable. Now, I know it's incredibly easy to get swept up in the massive addressable market of the global construction and industrial sectors, but we really have to remember a crucial distinction when evaluating these industrial ambitions. An addressable market is not revenue. Let me say that again. An addressable market is not revenue. XPON still needs to prove commercial adoption. They are playing a total David versus Goliath game right now. They have to actually secure the sales, outcompete established deep-pocketed energy storage companies, and navigate the structural challenges of an industry where the larger competitors can purchase battery cells way cheaper, simply because they have massive economies of scale. Okay, so now we have to pivot to the major bearish reality check. Looking at their balance sheet reveals a genuinely terrifying cash burn rate relative to their remaining capital. Let's walk through this math slowly because the stakes here are incredibly high. As of June 30, 2026, they had approximately $1.5 million in cash on hand. But in just the first half of that year, their operating cash used was approximately $2.6 million. This cash burn situation is the single most concerning data point in this entire explainer. A company simply cannot survive when its operational consumption outpaces its cash reserves this aggressively. The runway is incredibly short, and trust me, the clock is ticking very loudly. And because they're a microcap burning cash that rapidly, the need for future financing brings us to the single biggest threat to XPON investors: severe share dilution. Understanding how this mechanism works is absolutely essential. When a company with low cash reserves needs to keep the lights on, what do? They're forced to issue more shares to raise capital. This inherently decreases the ownership proportion and usually the overall value of existing shareholders' stock. It can create this notorious death spiral. If a company raises capital simply to finance continuing operational losses without clear evidence of accelerating revenue, current investors just get diluted into the ground. They absorb all the risk while the business just treads water. The structural problem driving that risk becomes painfully clear when you look at their trailing 12-month data. Over this period, they generated $8.2 million in revenue and brought in just $1.27 million in gross profit. But their corporate cost structure resulted in a massive $11.28 million operating loss. I mean, wow! That operating loss completely overwhelms the revenue scale. To fix this, they don't just need minor incremental growth, they need a massive leap in scale. For instance, if they could eventually reach, say, $25 million in revenue while holding that new 35% gross margin, well, their gross profit would jump to nearly $9 million. That's the threshold where they could finally begin to actually support this heavy corporate cost structure. So let's talk scenarios. In the bull case, if management executes flawlessly, driving revenue toward $30 million while holding those new margins, the upside is a literal 10x-style business transformation. Imagine they hit between $25 and $40 million in revenue. Forest River expands its orders across all product lines, the new EX1 battery gains incredible market traction, and those industrial DAS Gen applications actually start firing on all cylinders, becoming a meaningful percentage of sales. If their operating expenses grow much slower than this new revenue, that economic leverage finally kicks in, and the cash burn plummets. Because their current revenue base is so tiny, capturing just a small fraction of the broader lithium battery trend could have a disproportionately massive impact on the company's valuation.
But then there's the bear case. If revenue stalls and operating expenses stay high, investors will likely be diluted into the ground way before the company ever scales. Guys, this is the textbook definition of a value trap. If revenue remains below $2 million a quarter, if those fantastic gross margins slip back down toward 20%, and if the industrial expansion produces little to no actual revenue, that remaining cash will just vanish. they'll be forced into desperate capital raises. Shareholders will experience punishing dilution, and the stock will struggle, completely wiping out investors even though they operate in a highly attractive, booming energy market. Remember, a growing industry does not guarantee a surviving company.
Therefore, if you're an aggressive investor and you're putting this on your watch list, there are 3 absolutely critical metrics you must track over the next 12 to 18 months. The current stock price? That isn't the story. Execution is the story. First, you need to see revenue explicitly returning to greater than $3 million per quarter. They simply need scale to survive. Second, you must verify that gross margins remain strictly above 30%, proving that this new manufacturing efficiency is actually sticky and not just some one-off accounting fluke. And third, you need to see that operating cash burn falling dramatically. If those 3 things align, the investment thesis becomes incredibly compelling.
Ultimately, it all leaves us with one final, high-stakes question about the true cost of surviving in the fiercely competitive lithium battery landscape. Can this microcap survive its own cash burn long enough to capture its massive market potential? It is literally a race between operational scale and the balance sheet. Thanks for joining me for this explainer. Definitely keep a close eye on those upcoming quarterly margins, and I'll see you next time.